What's going on, YouTube? In this video, we're going to go over Nerdwallet, ticker symbol NRDS. So they reported Q3 earnings on October 26th, beat on top and bottom line. And after hours, stocks are up about 8.4%. Obviously, this was about almost 2 months ago now, but so obviously that is a pretty positive earnings report reaction from Wall Street. And as we can see here on the chart, was trading about $6.50 all the way up to about $10-11 per share in just a short amount of time. So year to date on this company, it is up 15% over the course of 1 year, up 17.4%. There is a little bit of short interest on the company, but not too terrible, especially for like a smaller cap company such as this. Also, as we can see here, forward-looking EPS is negative, and we just saw in the earnings that basically their full year EPS so far is also negative. So once we get over the valuation spreadsheet, we will only have a couple calculators to really utilize to figure out what this company might be worth today. So in their earnings call, there's a few things, well, not more than a few, but quite a few things worth noting here. So they reported strong audience growth in Q3 with monthly unique users up 22% year over year. So they currently have 24 million active users and is now up 22% from last year. So good growth there on user count. Also, once we get over to their 10Q, one thing to remember here is once we go to 10Q, it'll make more sense, but they've consistently said that over 70% of their traffic comes organically or from unpaid to our site, and that remains true today. So when we get over the 10Q, we're going to see their sales and marketing is, questionable as to why they're spending so much money on that when 30% of it comes from sales and marketing and the other 70% comes from just organically. So definitely something to keep in mind on once we get to that part. And actually, they kind of explain it right here. They recognize that our investment in sales and marketing has been roughly 70% of their revenue in recent periods. So I think that to me is something worth considering as an investor, because I think they're recognizing it. They don't seem to be cutting back on sales and marketing just yet. Also this quarter, their international team continued their expansion into Canada, making meaningful progress with 87% year-over-year growth. And at the same time, they're also ramping their efforts into Australia as an emerging player in this international market. So they gave some Q4 guidance. Guidance did not come in that great. So kind of surprised that the stock is up as much as it is. So what they're forecasting is basically at the midpoint, a 3% decline in revenue, but that is 12% revenue growth for the full year. But they also noted that typically, historically, they have seen a decline in Q3 and Q4 seasonally. So one thing I think we should keep a close eye on for next quarter is they're stating that majority of their brand spend occurred during the first 3 quarters of this year and are currently expect to have minimal brand spend in the fourth quarter. So again, on that sales and marketing, we want to probably keep a close eye on that because it soaks up so much of their current revenue. Also, another thing that I just don't like, so those are 2 things, the sales and marketing, and then also they're buying back shares right now, and they're not profitable. They do have positive net income, or sorry, positive free cash flow, but once we get over to their actual financials, we'll go through that a little bit more as to why I feel like it's not a smart move for them to be buying back shares right now. So they bought back $10.8 million worth of shares at $8.95. They also announced to buy back. They authorized another $30 million buyback authorization as well. So again, once we go to the financials, we'll go over that a little bit deeper, but 2 things that I am not a big fan of so far on this company. But over to the financials, let's take a peek and see how this company is performing. And we got a revenue, gross profit, net income. Both revenue, gross profit on a nice trajectory higher. However, net income, and we come over to our chart over here, does appear to be trending back to positive territory. Not quite there yet, but they're hanging in there right around 0. Gross margins, 91.3%. Fantastic gross margins, but net margins, they just soak up so much of their money in their sales and marketing, and we'll get to that momentarily. Revenue, gross profit, year-over-year change, they are starting to see some slowness in their growth on revenue and gross profit. So something else to probably keep an eye on, especially in a small cap company like this. Return on invested capital sitting at, basically 0. Earnings yield also sitting around 0. Cash and short-term debt company does have a pretty strong balance sheet. Net income to free cash flow. We can see net income basically hanging at zero there. Free cash flow, though, positive $35 million. Come over here. Here's our free cash flow. You can see we're making a nice turn to the upside. CapEx sitting at about $28 million. Appears to be somewhat leveling off. Share count dilution, we can see we are getting diluted as shareholders. We can come up here. We can see what they're doing with their shares. And they are issuing a lot of stock-based compensation. No common stock issued, but they are in the process of buying back shares right now, as we just went over. Over to the 10Q, we got our assets and liabilities, our balance sheet. And company's got $86.6 million in cash. We come down here to our liabilities. We've got $56.6 million in total liabilities. So we take 56 minus our cash. It leaves us with about $30 million in net positive cash balance. So a good balance sheet. Down to the income statement. So they've got last quarter in the trailing 12 month, or in the last 3 months, they did $152.8 million. This time last year, they did $142.6 million. So not significant revenue growth. Obviously, we've seen as about 13% roughly year over year growth on overall revenues. Sales and marketing. This is where it gets a little hairy in my opinion, where I think they could really cut this out, especially they already stated that 70% of their revenues come from or are just organically. They're not from sales and marketing. So I mean, if it's that much, maybe cut your spend down in half on sales and marketing, or get rid of it almost entirely if it really does not matter. Why spend it? So if you see here, if they were to cut out all of this, or at least half, let's say half, they cut out $50 million of their spend. You bring that $50 million down here, then you're net positive $54 million on your, your income from operations. And then you obviously got some taxes to pay. And then you would for sure still be positive net income just by doing that alone. So I think if they can cut this out, I think this company could turn a corner and start looking much better. And especially, like I said, they're already saying that it almost seems like their sales and marketing just isn't working. So I think this is something that should be kept a close eye on. And I think they should, in my opinion, either find a different way to sales and marketing or eliminate it or get rid of a good chunk of it. So that way they can afford to buy back all those shares that they issued. Over to the cash flow statement. This is for the last 9 months. Left-hand side, we're looking at 2023. So overall, net loss in the last 9 months was negative $9.5 million. They get to add in depreciation. They got a bunch of stock-based compensation as well getting added in there. Net cash provided by operating activities came out to be $42.5 million. We minus off our capex of $500,000 there. So that basically gives us a $42 million free cash flow on the company. So we come down here a little ways and we can see they repurchased common stock last quarter or last 9 months of $12.1 million. So we come down here, we can see this time last year, roughly, we're sitting at about $168 million. Actually, it's about, yeah, it'd be about this time last year because this will be 12 months. They're sitting at about $168 million. And now today we're sitting at $86.6 million. So they're burning through cash. And then they're on top of it going to buy back more shares. Another $30 million has been issued to buy back more shares. They are positive free cash flow. That's good. If they can cut out their sales and marketing to cover their share buyback, I see that as being a little bit better, but I'm still on the fence about why they're spending money buying back shares right now when they could find a different way to potentially spend that money, in my opinion. I think we'll have to wait and see what their sales and marketing does going forward. I think that's something that should be have a close eye on, in my, that's what I think. Also worth throwing in there is the CEO has been buying a lot of shares. We can come over here, we can see he bought back a bunch. He not bought back. He bought a bunch of shares. He bought 695,000 shares on September 12th, 688 on the 11th, and middle of the summer he bought 685. And in last year in December he bought 416,000 shares. However, the director has sold some shares. That's a nominal amount. That's not too much to worry about. But the CBO here is actually selling a lot, quite frequently here. It looks like almost every month, every quarter probably. January, February, then March, and then June, and September, and then So he's been selling quite a bit of shares. So maybe, bullish on the CEO buying back shares, but when you got a little bit of a mixed bag of executives buying shares and selling shares overall. Obviously, when the CEO buys shares, usually that's a bullish sign because the CEO oversees everything and thinks that the company is headed in the right direction. Or, so something to probably keep another close eye on to see if he starts offloading some of these shares that he's bought, and maybe he's seen that this is appreciated to what he thinks the company is worth today. So another thing to keep an eye on as well, I believe. So over to the comps, we have one other company here to compare to. I believe this is Lending Tree, if I am not mistaken. And we come down here to our comparable charts, and we can see that we can compare these two companies because they are competitors. Market cap, Nerdwallet, significantly higher market cap. However, Lending Tree, much higher revenue than where Nerdwallet is. Revenue, gross profit, and net income. And it looks like they got similar margins, right? Down here on gross margins. So your gross profit's pretty decent, but they are also a negative income company. Growth rate on the two companies, I mean, significantly higher growth rate expected on Nerdwallet in comparison to Lending Tree there. So over to our margins, we can see that between the two companies, gross margins pretty similar. We can see Nerdwallet could potentially push their margins up a bit more. Over to the operating and profit margins, we can see Lending Tree is not even anywhere close to where NerdWallet is on margins on that side of things. Free cash flow, we can see Lending Tree sitting at a higher free cash flow than NerdWallet, probably going to be because of potentially offering a lot more stock-based compensation and maybe some more depreciation, amortization getting added in there to have a higher free cash flow. Return on invested capital, and earnings yield, both significantly negative. So in terms of the competition, company's got a lot of work to do to catch up to where NerdWallet is today. Over to our calculator spreadsheet, Peter Lynch valuation, because we do have a negative earnings per share, that gives us a negative Peter Lynch fair value, so we will not be able to use that valuation on our final valuation. Multiples, Lending Tree also has a negative PE, so we do not have a multiples comparison. Manual PE, though, we can do is take our market cap minus cash, add in debt, divided by cash from operations. It'll take about 13 years for the company to earn its current market cap, which is pretty good. Price to book, 5-year average, 2.7, and today sitting at 2.3, also pretty decent. Forward-looking PEG ratio sitting at 1.66, which is telling us we are slightly below fairly valued. And that is obviously forward-looking PEG ratio, price to earnings divided by growth. Grams valuation, again, negative EPS, negative intrinsic value. The two valuations that we can use is going to be DCF and Rule 72 to figure out what this thing is worth. So currently this does have a positive free cash flow, so we can utilize this valuation, and currently sitting at $35 million positive. As we can see, historically, they are negative growth rate. They went from 17 to negative to back a little bit higher, but still negative to positive 35 million. And if they can reduce their sales and marketing, looks like they might be doing like they said for Q4, which would definitely increase their overall net income to potentially a positive net income even. That would then potentially carry over down to their free cash flows as well, which we could potentially also see a positive free cash flow growth rate. So I gave them a 25% free cash flow growth rate, which then gives them a DCF price per share of $17.32. Down to Rule 72. Again, negative EPS. So I said, you know what? Let's give them 5% EPS. Obviously, that's not today. That might not even be next year, because even next year, they're not forecasting positive EPS yet. But let's say they cut back on their sales and marketing, they can start seeing positive EPS again. So it gives them 5 cents, EPS growth rate of 32.4%, which then that gives us an opportunity to double our EPS currently by 4.5 times, which would put us right in this range. And I gave them a future EPS of 0.9 cents, 90 cents, which then gives them a fair value. Not today, because they do not have a 5-cent EPS yet, but if they do pull off a 5-cent EPS, we can start utilizing this number a little more carefully. But right now, we can assume a $14.58 fair value. So over to their summary. Currently trading $11.11. We have to eliminate some of our valuations that we did do to figure out what this thing is worth. So we come over here. We can see our fair market value on the two valuations that we can average in would be $15.95. 30% margin safety, $11.16, basically right where we're trading. Analysts also have a price target in the $15 range of $15.17. So we can potentially, if you want to, incorporate your analyst average or your analyst price target into your average to probably bring down your average a little bit, maybe bring it down to 1580 roughly, maybe for a fair market value. I would probably do that. I would probably incorporate all three of these valuations together to figure out what this thing is potentially worth. So over to our stock chart, we got three trend lines drawn in really. We got our support, we got resistance, and more resistance in the company, and there's probably even more resistance up here, like $15, but we got a pretty good clip to get to that. But so we can see right now we are trading, we are hitting our head on resistance, and potentially we could break through. If we do break through, we could potentially see get up to about 13-ish dollars per share before we hit another resistance point. You can maybe move it up a little bit here to get up to maybe 13, $14 per share there. Then I would have to say your next resistance point is probably going to be in the $15 to $16 range. So there's a lot of resistance in the stock chart, at least what we can see. A lot of stopping points. So we could chop around here for a little while, which we've done for many days. Punch up through, hit our head on this again, about $13, $14 per share. And I think this thing, if they can pull back on their sales and marketing, like I've said many times already, if they can do that and start showing positive net income, I think that's going to be huge for this company from an investor standpoint to see them actually making positive net income. And I think this will push this thing back up to like, potentially up to $18, $19 per share, because obviously it would drive up our fair market value if they can start pulling off positive net incomes, which would show a positive earnings per share. But that is my analysis over here on Nerdwallet. If you found value in this video, drop a like, subscribe, comment. We'll be back later with another stock analysis video.